We've had that inflation data for October come through, 18.9%. Of course, not as bad as what we're seeing in Uganda, with inflation sitting there at 30.5%. There's a somewhat of a lag between MPC decisions and the inflation rate. When do you see inflation in Kenya peaking?
We expect it to peak probably in this quarter, in the fourth quarter of 2011, and overall inflation, we expect it probably from the beginning of next year. It may begin to subside somewhat. We've had a pretty good year in terms of weather, so we expect the food CPI to start declining, and this will have an overall effect on the level of inflation.
So quarter four is when you see inflation peaking. Now, the IMF's new regional economic outlook for sub-Saharan Africa is pointing to inflation as the biggest red flag for them, even though they see Kenya growing at around 5.3% this year and 6.1% next year. How do you see this latest inflation data really informing the MPC decision tomorrow?
I think I don't think it will really have that much of an impact. I think they expected it more or less. And monetary policy decisions usually take a bit of time to filter through to the market. And I mean, we all know that the food pressure on food prices is bound to come down beginning of 2012. So MPC might not take the rise in inflation too much in consideration during the decisions. Although we did see inflation rose slightly higher than it did between September to October. It went up by about 1.5%.
Now, the CBR rate was hiked by around 400 basis points at the last meeting. Some are calling for a rate hike of up to 300 basis points. Are you expecting them to be as aggressive this time around?
Again, I think adjusting with monetary policy takes a while to filter through. Before, the MPC used to meet every 2 months. Now they've decided to meet every month, basically because of the volatility we've been seeing in the market. I'd say the market has been pretty stable through the month of October in terms of foreign exchange rates. Interest rates have begun to rise quite steeply, and this was expected because of the CBR rate hike, and also they've been tightening liquidity in the market. So going forward, I think basically what we might see, I think the MPC may keep the current level of the CBR or move it up slightly.
And banks, of course, have been responding to that hike in the CBR. KCB, for one, hiking its lending rate to around 19%. So the cost of funds is becoming increasingly expensive, and many in Parliament in Kenya calling for banks to limit the growth in interest rates. But of course, that will be difficult given the fact that we've got the CBR sitting at that point. So that may be one reason why we see them holding back on interest rate hikes.
I mean, we're in a liberalized market. There's not much that the government can do in terms of restrictions of interest rates. Although there is a bill that they want to bring to Parliament where they want to limit the spreads between deposits and basically between deposits and the rate of lending. This may somewhat act to control the rates, but in the meantime, I think banks will just react with the market.
And of course, the shilling has performed a lot better subsequent to that hike in interest rates. What's sitting at 99.20 at this point, below that 100 shilling mark. Where to from here for the shilling?
I think, okay, the policies that Treasury put through have had much more of an effect on the Kenya shilling than the MPC decisions decided at the beginning of October. Basically, the restrictions on trading the Treasury the CBK brought through, and also on the exposure that the banks can have of foreign currency. Those have had the major effect. That's what we've seen the shilling actually strengthen.
Ken, what do you think of those restrictions?
Taking a long-term view.
Sorry, just what do you think of those restrictions? Because restricting offshore banks from trading in the currency, how sustainable is that?
I think it's actually a very effective measure, albeit a bit crude. It's a very effective measure. I mean, we've seen the effect it had on the Kenya shilling, and that's what I'm saying, taking a long-term view. Of course, it's not a long-term policy that can be held in place. They'll need to continue tightening liquidity, and also we'll need quite a bit of foreign exchange to come into the country, maybe through the IMF or issuance of a Eurobond.
Ken, very quickly, we've had housing finance results out today, 63% there, increase in third quarter earnings. So once again, some strong earnings coming through from the banking sector. Interesting that they're looking to come to the bond market to raise some funds, especially on the long-term side of things, where the CBK is not even issuing long-dated paper.
I'm not quite sure how informed the decision is to come to the market to issue. They're talking about a 25-year paper or longer. In the current environment, that would be very expensive for them, because they'd be looking at above 20%, because a similar tenor government bond is priced at about 18 to 20%, and they'd have to put a spread of around 200 to 300 bips for a corporate bond. So not a very, I wouldn't recommend it, not a very good decision. The environment is very unfavorable. There's also the other option of looking at the equity market, such as what KQ is doing. Although, and we've actually seen the equity market in the last week has started to respond pretty well. I mean, the index is up above 3,500. So, I mean, they don't have so many options, but we'll see what they decide.